Hey everyone, this is Robert Keens with goldsilverpros.com. It is Thursday, October 29th, 2020. We're a couple of days away from the end of the month and the start of a new one, and just a few days away from the presidential election. Today, I'm going to be covering a new topic for the channel, and it's going to have to do with interest rates. It's the transition from LIBOR to SOFR, because there's been a lot of chatter about this on the internet. And I think there's some, maybe some fear mongering going out there. And I wanted to dispel a little bit about that and maybe bring you some risks that other people are not bringing you with regards to this change. It's big because it affects potentially $200 trillion of the economy. So it's a really big factor in how healthy the economy is going to be and how we determine the interest rates or the borrowing costs for $200 trillion worth of the economy. So I'm going to get into that really quickly. And the title of the presentation is Coming Financial Cataclysm or Another Y2K, the transition from LIBOR to SOFR interest rates. I've been following this for quite some time, and I purposely have not recorded a video on this because I wanted to see as we went along, essentially how much of an issue this was going to be for us. And I think some of the things that people are talking about are not quite as big an issue, but I think people are missing some of the bigger points as well. I'm going to get into that at the very end of the presentation. So let's explain what the heck is LIBOR and SOFR and why should you care? LIBOR, according to this report from BDO, stands for London Interbank Offering Rate, also referred to as an IBOR. There's the LIBOR, which is the London Interbank Offering Rate, and there's a bunch of other IBORs for other countries around the world. Their interbank offering rate. It's meant to reflect the rates that the world's largest banks charge each other for short-term loans. It is the most widely used benchmark interest rate today. That's why it's important. And it presently published across 5 different currencies and 7 different maturities. Why it's important. LIBOR sets the interest rates for 200 trillion in financial products around the world. That is a lot. It is default interest rate in industries like mortgages, or at least the old mortgages, the RMBS, which we'll get to here in a moment. LIBOR is used to represent bank-to-bank transactions, or it used to represent bank-to-bank transactions, which fell off a cliff after Lehman. So after the mortgage crisis in 2008, 2009, interbank lending really started to slow down because the banks essentially didn't trust each other. So they didn't lend to each other. And the Fed basically became the lender of last resort. And so the transactions underlying LIBOR actually fell off a cliff. So we have these LIBOR transactions affecting this massive market, but it's not really a true measure of risk, and we'll get into that. So now the rate is manufactured by 11 to 16 panel banks at any given time on what they might charge others for short-term loan, but it is a supposed rate, not an actual real-life interest rate. So it's a bit of a false interest rate. We're going to explain some of the LIBOR history, including a scandal that was uncovered in 2012. It was first created in 1980. The British Bankers Association published their interest rate swap BBERs, and the first LIBOR rates were published in the dollar, the British pound, the Japanese yen in 1996. 1990, LIBOR was firmly entrenched as the best benchmark interest rate. The financial crisis in 2008 highlighted that the LIBOR rates spiked, of course. Interbank lending slowed down there, and there was a lot of risk as some of the banks were starting to fail, and there were shocks in the financial system, so the rates spiked. Rates will spike when the risk goes up. Makes borrowing, of course, very, very difficult on short-term loans. LIBOR scandal was uncovered in 2012, in which there was massive manipulation of the LIBOR rate, of course, affecting, again, $200 trillion in the economy. So we had mispriced the interest rate charged in $200 trillion, I'm sorry, of the global economy. So they began talking about ways in which we could come up with a new system. And along the way, Deutsche Bank was fined $3.5 billion for its role to scam and manipulate the LIBOR. UBS was charged $1.5 billion, RBS 1.1, all these fines you can see in this chart as a result of the rigging scandal. So of course, I think in 2014, a panel was convened in order to figure out what to do. In 2017, guidance originally came out about moving on from LIBOR into something called SOFR. I wanted to print this chart here showing the current gross notional outstanding of all financial products related to US dollar LIBOR. Of course, about 190 trillion with a T is related to the different derivatives markets, and almost 9 trillion in cash related projects and in the dates in which they mature. Most of it matures By the end of 2021, as you can see, the gray lines, the yellow is between 22 and 2025, and then the rest as we go along all the way up to 2040, the vast majority of it expiring by 2021. SOFR is now replacing LIBOR, according to Morgan Stanley, and there are only a few transactions per day, valued at about 500 million, that actually make up the LIBOR, but that affects $200 trillion worth of other transactions worldwide. So you can see the mismatch in what is actually determining LIBOR versus what interest rates are based off of that LIBOR. So the LIBOR rate is therefore mostly a human estimate of what interest rates should be based on relatively little data in the market. The SOFR, however, is based on transactions in the US Treasury repurchase or repo market, where banks and investors borrow or lend treasuries overnight. The Fed began publishing SOFR rates in 2018. Now, remember a video I had in the past where I talked about the repo market crisis and how the Fed was pumping money into the repo market. I actually called this in December of 2018 when I went on Lynette Zhang's program. I flew down to Phoenix, Arizona, and we did a video together. We're talking about a lot of things, and I called the liquidity crisis that was going to occur in the dollar market, although I didn't peg it specifically to repos. I did say we're going to have a liquidity crisis. That was in December 2018. I published it on my YouTube channel back then. September 2019, I guess about 10 months later, there was a repo crisis, and it was caused by a lack of liquidity, dollar liquidity in the system to service all of these loans and to provide overnight liquidity for businesses to transact. So what's the difference between the SOFR and the LIBOR? So here again from Morgan Stanley Research, both the SOFR and the LIBOR reflect short-term borrowing costs, but key differences between them make the transition tricky. First of all, SOFR relies entirely on transactional data, whereas LIBOR is based partially on market data expert judgment. Secondly, SOFR is purely a daily rate, what they call an overnight rate, versus LIBOR's 7 varying rates on terms from 1 day to 1 year. And LIBOR incorporates a built-in credit risk component, but SOFR does not. It's risk-free. It's based on treasuries, what's considered the risk-free rate. Given these differences, USD LIBOR can't simply be swapped out with SOFR in existing contracts that reference LIBOR, at least not without appropriate adjustments. And we'll get later in the presentation about what that is. And that's the risk that most people have been focusing on, is the transitional effects from LIBOR to SOFR and how this could potentially crash the system. And that's why I got to the title of this presentation, is it Financial Armageddon or Y2K? I believe it's closer to Y2K, and I'll get to that here in the presentation in terms of the transition from LIBOR to SOFR. But when we get on SOFR, I think new risks are introduced, and those are the ones I think are the real ones. And I'll talk about that later in the presentation. And I don't think you're going to get this perspective from anybody else. I haven't seen anybody else really talk about this. Additional comparison between LIBOR and SOFR from the sources I've already given you in the presentation. This comes from one of them. LIBOR is a bank-to-bank lending rate, which includes credit risk. SOFR is based on treasuries, no credit risk. LIBOR is unsecured, SOFR is secured by treasuries. LIBOR is forward-looking, SOFR is backward-looking. It doesn't have a forward-looking component. So how it's going to function as a forward-looking interest rate mechanism is being called into question. LIBOR has a term structure. There is no term structure on SOFR because it's backward-looking, not forward-looking. There's no forward term of 1 year, 2 year, 3 year. LIBOR is based on bank submissions and expert judgment. In other words, it's largely human denominated. SOFR is transaction based. LIBOR is based on about 1 billion of transactions per day, where SOFR is based on 1 trillion transactions. So in some cases, you look at SOFR and say, well, that's actually a better rate, except for maybe it's not, and we'll see why. But I also wanted to point out that while the US is going to the SOFR, each of these jurisdictions is going to different risk-free rates, as you can see in the middle column. The United Kingdom is going to something called SONIA, Japan, TONA, Europe, ESTER, Canada, the CORA, and so on and so forth. So, but we're going to focus on SOFR because that's where the USD market financial transactions are going to be based on. But if you want additional information, look up these other ones as well. So when does this all go down? Well, according to Chatham Financial, by the end of 2021, LIBOR should begin to fade away. That's about a year from now, but it's not required to, and that's key. It depends on how many of the 11 to 16 panel banks stop posting their LIBOR rates. Now, if banks decide that the transition from LIBOR to SOFR is not ready, they can continue publishing LIBOR. So it's not a hard date. So the scaremongering of by the end of 2021, all this has to occur is actually not correct. They can continue publishing LIBOR for as long as they need to get all of the transitional things in place that they need. And I'll show you where corporations and banks already have these transitional processes in place. So it's not a big risk as people think. but also that LIBOR could continue to live on by 2021, or if everybody gets everything in order, it could die faster. So December 31st, 2021 is not a hard date. So people who are saying it, December 31st, 2021 is the new financial Armageddon date are actually incorrect for these reasons. A quote from the Chatham Financial article. However, in February 2020, Fannie Mae and Freddie Mac announced they will stop accepting LIBOR-based loan applications after the end of Q3 2020. So that would be, that would be now already, because you have October, November, December. So at the beginning or the end of September, they stopped accepting them. And they'll stop purchasing LIBOR-based loans by the end of 2020. So you got a couple more months left before they'll purchase your loan if it happens to be LIBOR-based. Other agencies have not stated their intent. This is as of September 21st. So not a lot of other agencies and authorities have said when they're going to actually make this transition. So it's in question. And so, yes, there is some, worry out there about this transition, but I'm going to show you why it's not quite as big of a deal. Again, from Morgan Stanley, is this financial Armageddon? A quote, different securitized products reference LIBOR and underlying loans and the bonds themselves, swaps within deals, and any combination thereof. Legacy non-agency residential mortgage-backed securities, RMBS, are the most exposed to this rate transition, since most reference LIBOR. However, this group presents a small and shrinking share of the market. At its peak, it was about $2 trillion, but right now it's only $250 billion. So not that big of a deal in the mortgage market. Meanwhile, newly issued securitized products and most outstanding agency mortgage-backed securities already have a fallback clause spelling out how rates will be handled during the transition. So in other words, they knew the transition was going to occur in 2014. They formed the committees and the panels. 2017, they started issuing guidance. So they've had 3 years to get these fallback clauses in new contracts. So think about it. If you're refinancing your mortgage, you're going to get a mortgage paper with the fallback, or these other financial dealings are already going to have these clauses built in, and the clauses have already been basically outlined. So they had 3 years to do this, and they've got another year until the end of 2021. So a lot of this can get done, and and a lot of what is set in stone, concrete, long-term mortgage contracts only represents $250 billion. So I don't think it's financial Armageddon, the transition of it, but we'll see where the risk really lies after the transition occurs here in a few moments. Well, the other risk is, what about the banks? Their financial balance sheets and all the exposure they have to this market and the transition from LIBOR to SOFR interest rates. How does that affect them? Well, here's another quote from the same Morgan Stanley article I showed you a moment ago. They say that it's too early to estimate how the transition from LIBOR to SOFR will impact earnings for U.S. banks. Morgan Stanley analysts believe that banks first need a functioning SOFR derivatives market. I'm going to get to that in a minute. Derivatives market, think about that for a moment. To enable the hedging required to manage their balance sheet risk. As the derivatives market linked to SOFR grows, it should also help increase market depth and the liquidity needed to assess credit spreads. This is a bit of a chicken or egg scenario in which insurers want to see more liquidity before they adopt SOFR, but the liquidity also hinges on them adopting SOFR. It'll get going. You'll see a bank, you'll see issuers do it, more issuers do it, and it'll be like dominoes falling. It eventually will occur. Hurdles to switch over. And this is where we have existing procedures and facilities in most companies and banks and things to handle the switchover. It's really not going to be as hard as you think. Education of company management. Check, can handle that. Assessing LIBOR exposure, that's an accounting exercise. Check. Renegotiating contract terms, that's a legal exercise. Check. Reconfiguring both software and data flows. It's going to be a lot of money, but check. You've got your technical and IT teams. Redo the financial models based on LIBOR. That's actuarial and accounting. Check, got it. Litigation and risk procedures, that's your general risk and control, your GRC teams, and your legal teams. Check. Accounting rules and financial reporting. Okay, so maybe the PCAOB, the Public Company Accounting Oversight Board, needs to issue some new guidance and maybe a FASB rule or something along those lines. Check. We have the facilities to do that in America. So I'm not as worried about the actual switchover. Now we get to what is the real market risk. And this is, I think, what a lot of people are not talking about. That's what I want to talk about. And Chatham Financial, one reason I referenced Chatham Financial article, it's a wonderful article because it picked up on one of the biggest risks. And it's a long quote here. I'm going to read through the whole thing, but stick with me. This will pay off. This is what you guys need to know, understanding the risk underlying $200 trillion worth of world economy, the interest rate risk for that. It's really important to understand that going forward to see where we can have our next meltdown in the economy. If we have our next meltdown in the economy, that's what you want to protect yourself with gold and silver 4. So we're getting to one of the reasons why you want gold and silver right here in the next few slides. So remember, it's the repo market that the SOFR is based upon. Who was intervening in the repo market? The Fed. Now listen to what Chatham Financial has to say. SOFR is a measure of the overnight cost of financing US Treasury securities in the repurchase agreement market, repo market. It includes market data from bilateral trading and the tri-party repo market. The dynamics driving pricing, volatility, and risk in the US Treasury repo market are therefore closely aligned with those driving SOFR levels. Aha. So the Treasury market risk is now closely tied to the interest rate risk on $200 trillion of other related financial transactions. Does anyone see a problem there? How healthy is the US Treasury market? Gee, I don't know. What have we been talking about for the last 10 years since the last financial crisis? All right, and it gets better. The Fed's federal, and I'm down here in the middle now, right here in the middle section. The Fed's Federal Open Market Committee, the FOMC, is responsible for periodically setting targets for several key interest rates enforced through open market operations. The New York Fed conducts both repo transactions and reverse repo transactions in blah, 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 blah. In a repo transaction, the New York Fed is a lender providing reserves to primary dealers, which equates to a collateralized loan. In the reverse repo, the Fed reduces reserves by effectively borrowing funds from the market. The Fed's involvement in the repo markets, meant to ensure an orderly and liquid market, influences the SOFR rate by effectively setting both a floor and a ceiling on repo rates. When the Fed lends funds via repo, they implicitly provide an avenue for primary dealers to convert their Treasury and MBS holdings to reserves. This can act as a backstop, encouraging those dealers to lend out reserves to other market participants. Aha, affecting the rate. Liquidity affects the rate. Less liquidity, higher rates. More liquidity, lower rates. Think about it. When the Fed borrows funds via reverse repo transactions, they provide an alternative means for market participants to earn interest on their excess cash, which by design keeps the Fed funds rate from falling below the lower bound. As a result of the Fed's actions, SOFR has averaged around 5 basis points since April 2020. Market uncertainty with respect to future Fed actions may introduce additional volatility to repo rates and therefore to SOFR. So now as the risk to the from what people anticipate the Fed is going to do translate to the Treasury market, it now translates to $200 trillion around the rest of the world in other financial transactions. Oh, gee, so now the Fed melting down is not only going to affect, or the Treasury market melting down is not only going to affect the Treasury market, is going to affect all these other financial markets. I don't think anybody's talking about this. This is astounding. This is an astounding level of new risk being introduced into the financial system. And we go on, there's more. Well, according to one of the references above, I believe it was Chatham article, SOFR could lead to liquidity shocks. This is a direct quote. Lack of credit sensitivity. Another key challenge is that some market participants, notably U.S. regional community banks and financial institutions, have argued that, in red, I bolded this, SOFR does not reflect a typical bank's borrowing or funding costs. Oh, gee. Nearly as accurately as LIBOR, because SOFR is a risk-free rate. Why? It's based on treasuries. What is the quote-unquote safest considered debt instrument? It would be the U.S. Treasury. It's considered the risk-free rate. So there's no risk premium built into the SOFR rate. Key. Their concern is that SOFR potentially could reduce the availability of credit under market stress, reduce the availability of credit under market stress, i.e. the next meltdown. And in response, others in the market have designed alternatives to better reflect banks and financial institutions. So in other words, these community and regional banks are saying, screw this, we're going to develop our other measures. And we've got the Ameribor, the ICE Bank Yield Index, the IHS Market Dynamic Credit Spread, because they're already seeing the problems that you can have less liquidity at the exact time you need more liquidity during, I don't know, a market shock. So what could cause a market shock? The risk in the Treasury system propagating out to $200 trillion in financial transactions. And at the same time, we can have a liquidity shock because of this reason, because there's lack of credit sensitivity. There's not risk built into the SOFR like there was the LIBOR that reflects borrowing and funding costs. Borrowing and funding costs, what happens when there's more risk? Goes up, less risk goes down. That's now out of this benchmark rate, the SOFR. Does anybody see a problem there? I see a massive, massive problem that not many people are talking about, although this article really picked up on it. And of course, we get to the most fun part. For those of you watching my CME videos talking about manipulation of the gold and silver markets, which I spent about 2 months harping on, that happens through the derivatives market. Well, guess what they're going to do with SOFR? In order to create forward rates in SOFR, because remember, SOFR is a backward-looking rate on existing transactions. In order to create a forward market for us actually to use this interest rate in forward-leading products like, I don't know, mortgages and everything else, we need to know what's going to happen in the future. They have to wrap a derivatives market around the SOFR. A quote from Pensford at this link that I'm providing you. Forward-looking term rates will be based on SOFR futures, because remember, SOFR itself is backward-looking. So all of the forward rate is based upon the futures market. And what have I said about the futures market? It's manipulated. And they are dependent on the development of a large and robust derivatives market. While the CME, the CME, manipulation of the gold and silver market, they manage it. While the CME began offering SOFR futures in May of 2018 and trading volume had been growing consistently, the size market is still relatively small. Well, guess what? When everybody moves to SOFR on US-based contracts, the derivatives market for SOFR is going to go bazonkers. And what does it allow big entities to do? Big entities are going to be able to control the future rates through the derivative market. So instead of a panel of 11 to 16 panel banks setting the LIBOR rate, now you got it manipulated in the futures market. So let's put it all together. Because of liquidity risk shock, the Fed will have to permanently intervene in the repo market to support the trillions of financial products now priced in SOFR rate. They will never, in the history of this system, ever be able to stop intervening in the repo market at all times 24/7. Because remember, it's the overnight market. Gee, how well did participation in all the other markets go for the Fed? Derivative markets can be manipulated by large players to affect the pricing of SOFR derivatives that will affect SOFR forward rates. I just talked about that in the last slide. And we will never have a true market interest rate that reflects real risk in the system, so we lack a system meltdown barometer. Why? Because derivative markets can manipulate the forward rate not based on what we actually think the risk is, but based on making money on the derivatives. It's going to become a gambler's market. It's not going to reflect actual systemic risk. In fact, it may increase systemic risk, but because the derivatives are going to be so far decoupled from the actual risk in the system of the monetary flows, because it's a gambler's market gambling on the derivative itself, that the two shall never meet. The derivatives market will, and the forward SOFR rate can never reflect the actual risk in the system. And at the time at which we need the most liquidity during a market shock, the SOFR is not going to be able to provide that. If we go back to leading to liquidity shocks, it does not reflect a typical bank's borrowing or funding costs. It lacks credit sensitivity. And that's why these other banks are creating these other indexes, which they think are superior to the SOFR. That's the real risk. So going back, is it financial Armageddon, the transition from LIBOR to SOFR? No. The agencies that we need and the processes we need are in place. And LIBOR can go longer if it needs to be, but eventually people are all going to switch over to SOFR. Now, you could have some lawsuits around those $250 billion of existing mortgages that are pegged to LIBOR. Sure. Is that going to crash a global financial system? No. No judge in America and no courtroom and no jury is going to crash a global financial system over $250 billion in mortgages. RMBS mortgages is not going to happen. They'll figure it out. They'll figure out fair settlements, and it'll be a lot less than $250 billion. It may be a few million, tens of millions. It's not going to crash a global financial system. So the transition, that's not the big worry, but that's what other people have been reporting on. Here on my channel, we look a little bit further into the future and we found the other risks: the derivatives market, the manipulation, the liquidity shocks, and the fact that the Fed now has to permanently intervene in a market, and it's going to affect the market that's pricing $200 trillion of financial products across the world. Ain't it great? So that is a massive, massive risk. And I definitely wanted to share that with you guys, because if you're looking for a black swan, black swans are things like banks melting down, like Deutsche Bank, Wells Fargo or something like that. Maybe this is the black swan. Maybe the black swan is we have so far decoupled using derivatives and tying everything to the risk-free treasury market. We have so decoupled the risk warning signs, the risk dashboard, the light that comes on your dashboard that says you have engine trouble or a flat tire. We have so decoupled those warning systems from the real risk in the system that we're not going to know when the next financial meltdown is coming. it's going to obscure the actual meltdown because we're not going to have that barometer with the SOFR rate. Now, the LIBOR rate wasn't perfect, but at least you had some people looking at the market and they could move it up and down. The SOFR rate's backward looking, and the futures is going to be totally disconnected. It's going to be a gambler's market that has nothing to do with actual risk. And the only time that you'll see the risk appear in the derivatives market is before it's too late, because the derivatives players will dump on the market all their derivatives when the stuff is going to hit the fan. But by then it's too late. And then the barometer will click in a few minutes, maybe a few milliseconds before the actual meltdown starts. Danger, 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 Will Robinson. Danger, danger, danger. This could be a black swan. We'll be watching this throughout 2021. We'll be watching it afterwards. I don't have a good feeling about this. I don't like the fact that we're tying these rates to treasuries and Fed intervention and decoupling it from traditional risk measures. I don't think people understand how this is going to affect our understanding of risk in the system, the pricing of money through interest rates. I think now it's just a complete and utter Ponzi system. It's a derivative-driven Ponzi system that requires endless Fed printing. And if you thought it was bad before, it's even worse now. It's even worse now. And that's why you want to hold gold and silver, because it's your refuge. If you're holding any paper derivative investment, tech stocks, bonds, anything that's going to be based on the SOFR rate. If you own a bunch of rental properties right now, that's why I got on my rental properties. The pricing of those rental properties, it may be determined by these rates. I mean, there's so many cascading effects throughout not only the US economy, but the world economy. They're going to be affected by this. And the obscuring of the real risk in the system is, to me, the biggest risk. I don't get a really good feeling about this at all. And so I wanted to bring you this information, guys, because I think you need to know it. And I think I'm one of the very few first people that's talking about the real risk in the system. I don't think a lot of people are talking about it. It's not the transition from LIBOR to SOFR. I think we'll get through that. It's what happens after. That's when the real shit hit the fan moment could occur. And you got about a year. So I don't know. I don't think that once we flip over to SOFR, the risk is going to go that quick. But it means we're in the accelerated part of the risk paradigm in the financial system. When we flip over to SOFR, because we're losing barometers, we're forcing the Fed to intervene, we're manipulating the SOFR rate and the derivatives, you're never going to know when the meltdown's coming now. You're just, because the warning barometers are being turned off, or they're being obscured, or being destroyed, essentially. So again, don't get a good feeling. Now, I've called the financial meltdown would happen in the next couple of years. I think this is another indicator it could happen, but we'll have to see what happens. So stay tuned to the channel. Until next time, this is Robert with GoldSilverPros.com.